Hi, and welcome to the first of many talks about investment ideas. My name is Jordan De Los Santos, and I'm here with Antonio Velardo from Real Capital Caribe, and we are going to talk about the opportunities that we find very interesting for the investors around the world. Antonio, how are you?
I'm fine, thanks. Great.
Antonio, what can you tell us about Real Capital Caribe?
Real Capital Caribe is an investment company that source and locate investment opportunities around the globe, around the world, and it looks for assets that they have low volatility, a great possibility of appreciation, and a stable and constant cash flow during the years. And we locate those investments, and develop those investments, and then pass it on to our clients, and we manage for them, so clients can invest in a passive way in those investments and have constant cash flow coming in their portfolio. That's what we do in general.
Good. And how do you pick those places? Because it is a big world right now.
Yeah, we have a very sophisticated and complicated data set which we process. Okay, so when we talk about data, we first of all have a way to understand what sort of data to use and how to validate those data. When we have these informations, we process them according to an logarithm or according to an equation, okay, which will consider different factors. For example, some of them could be the interest rate, the debt of the country, the possibility of the country to grow, the GDP growth, it's for it on. Anyway, we don't only look at these things, we obviously understand referring to that particular asset if the law and the political situations of the country, could guarantee our clients. For example, in the case of Dominican Republic, we have a country which has a big track record of safety when it comes to ownership of land, real estate. That's what we're doing here. That's, for example, also. So once we covered the due diligence about how safe is to hold asset in that particular country, and there is also the matching with the criteria that we have established, then that's where we move then on and start to buy things.
And Antonio, what have you done for your clients so far? What can you say that you have offered to your clients in the recent years that you think is beating the market with it?
Clients in the last 10 years have been extremely happy. We came, after we left Europe, we came in United States right in the right timing, 2010, 2011, and we were starting by we were buying real estate owned properties and short sale foreclosed property by the bank, rehabbing them, and in a time where the assets were very low, and those assets were performing, between 8 and 12%, sometimes even more, constantly, okay, during those years. And meantime, they had a great capital appreciation. So most of our clients, when we actually told our clients to sell in 2016, most of our clients are extremely happy. They made 3 or 4 times their money, and meantime, they had already paid the property because the dividend was really, the yield was really high, and they invested very happily in a new market.
And talking about yield, what is a good yield for your clients?
Well, my clients are looking to outperform inflation, okay, of 3, 4, 5 points. So we usually generate stable investment, which should be around between 7 to 10%. Ideally, our clients are looking for at least 10%. Obviously, as long as the risk itself is manageable, and our clients are really, our investments are really low risk. You have a property, you have loan backed by asset which are worth more money than nominal loan itself. So clients ideally looking for 10%. We always almost provided them that kind of yield. Usually the least that they usually get is 6.57, and they're quite stable. So they're really happy with that.
And what about the assets? Where do you have it right now? Where are you locating your assets?
Yeah, if you're talking about the current asset we're having, after we left the States, we came to invest in the capital of Santo Domingo. We have 2 hotel. One is under construction, one is already built and performing. The one already building both of them are in the best area of Santo Domingo. It's the area where all the embassy is, the economic heart of the capital and of the whole country, really, because the capital is in Santo Domingo. I mean, in the Dominican Republic is the one that absorbs all the business from all the country. It's the best area of the city, and it's a new properties. It's a condo hotel, new project just built. And they producing, depending when clients bought the unit, but clients that bought in the beginning are getting 11-12%, and the clients that bought later on stage are getting anything between in the process of constructions, like at the end. Some of them bought a bit later on. They obviously with the price increase, they probably getting anything between 8.5 to between 7.58 to 9%. So they're really happy, and actually rates are increasing. And our occupancy rate is very high. So we are, I think they're performing really well.
And why hotels? Why in the Dominican Republic?
Yeah, that's very interesting questions, and I'd like to take time to explain the process. What happened in the United States, with our investments were performing really great due to the timing that we actually had investing the right time in this kind of asset, in like single family homes which are foreclosed and owned by banks. And what happened is the cash flow was good, was very steady, was very high. But even if we rehab the house and if we did an amazing screening, very thorough screening on the credit side to understand to which clients to lease, which tenants to lease the units, we had sometimes a little, we always try to improve our company, to do things that will improve our process. And we had obviously a small standard deviation, so the yield was stable, but sometimes would eventually drop 1 or 1.5 points. It was very high, so people wouldn't care. And the main two factors that made our, sometimes our performance, losing 1 or 2 points was due, one, to the fact that the property, even if it was fully rehabbed, still was old, so you had made the piping system that could need change, or air condition falling, and things like that. So
you're always reinvesting money to
so
maintain the property.
you have a capex that need to consider that could eventually drain part of the profit. If you have 11.5, 12% yield, you lose sometimes 1.5, 2% out of it. People are still very happy, they were. But we thought and then there was a tenant. There was an issue with tenants. We were investing in mostly blue-collar area. And in those area, even if you do a very thorough screening, you understand the credit, you try to select your clients in a very sometimes obsessive way, you still are in a situation where those clients, if they lose their job, they won't be able to pay your rent. And that's where eviction comes. Eviction was very easy in the States, it's an easy process, takes 2 or 3 months, but in that time, you might lose some revenue. So we thought how we could optimize that, how we could find assets that they perform really good yield, but at the same time do not have the risk to, just to have the standard deviation, which is really, we don't have much movement. So exactly, volatility. So, and we understood that, for example, the condo market in the States, the one that are, in Brickell, for example, Miami, and then in the city, the client probably would not suffer, any kind of maintenance issues like the house, because they were newer, okay? And the clients were A-class, and obviously, with jobs above 80 or 90, $100,000 income, usually they always pay. However, the cost of the maintenance, the HOA, the community fee in the States was that high for that kind of building that will drain, all the yield out. So, it would not make sense because a property could only give 3-4%, sometimes even lower than that. Even if
because of the high cost.
Because of the high cost. But in the Dominican Republic, we find out that there was area like this, which, Piantini is a high income area. Piantini income is probably similar to South Beach. I mean, people are wealthy, they make money. There is, there is a business coming here. So, so you can have a target of executive coming from abroad, or even local executive that are that work in the city. And that is the first problem gone. And the second was that if you build a new condo, clients have a warranty for at least 10 years, and supposedly for the next 10, 15 years, you shouldn't have those kind of maintenance issue. And we find out that the rent were really high, so the business was very sustainable. Then that's how we invested in here. Now, there is something that I want to add about the opportunity that we find. We understood, that's really important, we understood that there was a gap in the market. We understood that Dominican Republic was growing, and there were hotels like, for example, at the time the Marriott was just building. There were just business hotels which were very expensive, like the Marriott and the Intercontinental came later on as well. And so there were not really, the market, the travel industry was totally disrupted by the digital revolution. So before, as you remember, they were playing. They were also travel agents. They were bringing their own clients wherever they wanted to, because clients going somewhere were so attached to an operator that they could trust. Being
to take them to the good hotel.
Yeah, exactly. Take them to a hotel in a safe place. But now it's totally different. Now people travel all over the world. They can find out information.
They got reviews to check.
Exactly. With OTA, the OTA are really new, the online travel agents. The platform, mostly Booking, Airbnb, Expedia. Those are the ones that actually decide where the clients goes, because millennials mostly, but also older clients, they look for opportunities in the city center. They look the best location. They go through the reviews, okay, and that's what is their passport to that's where they see which is the best option to choose. And the name, the brand itself, like the Marriott, Intercontinental, does not make much difference anymore, because it's not itself a guarantee of a good service. Okay, so what happened is, and Marriott and the big hotel chain understood that, so they changed the business model, and they were not investing anymore heavily into the structure itself. They were actually franchisee, their model to business people. So what happened is, business people then had an issue where they were buying top locations. They had the brand. They had to pay a franchisee fee. Sometimes very expensive, $250,000, $300,000, $500,000, $1 million sometimes, and they had to pay a constant, revenue, like a percentage of the revenue to the hotel brand. And what they are getting in change is just a system that everybody has. Like, maybe Opera or Site Manager, which is a software which are very well known now for years, that manage the hotel. And really, what happened is that they would fall themselves into a situation where they have what is called high leverage business. What high leverage business? High leverage business is a business which has very high cost, okay, independently by the turnover that they have. So the cost is connected more to the structure itself than not to the flow of people coming in. If you go to the Marriott, does not really in the city center, like in the Blue Mall, does not really matter if they have 100 or 1,000 people. They will have almost the same kind of cost, because they have the lighting, they have the infrastructure, they have the people they have to pay, and things like that. And that means that to have what is called in the industry contribution margin. Contribution margin means after the fixed cost, how much I can make for each room. You need to set up your fee really high, and versus,
if you want to keep happy the investors, you gotta give a really high rate.
You need to have really high rate, because an owner of this hotel need to has a mortgage to pay, he has a fee to pay to the main brand, like for example the Marriott. He has certain standards to keep, and that's very expensive. So you cannot lower the price dramatically in case of because you're gonna lose money in case of downturn, for example, in the market. Versus another kind of model, which is the condo hotel, where you're located in the same kind of locations. You have but you have a low cost, so your cost would increase, not because of your structure, which is very light and flexible, but because the people are coming in, so we'll be connected to the people. So that's called low. It's a low leverage business in the sense that if you make more people, you increase your cost, but you don't care, because that cost is a base of your business. But your standard cost, your fixed costs are kept low. And my clients, most of them don't have any kind of mortgage on the property. So one of the issue in the Dominican Republic in particular, in the hotel industry in general, but in the Dominican Republic in particular, is price sensitivity. This country is very price sensitive. What does it mean? It means that at a very small increase in price, okay, you can have a bigger decrease in demand. So you need to really play with prices. And we're flexible. We can do that. I can drop my price now 35, 40%. in the case of downturn, and my clients will be still getting, we will be full, and my clients will be still getting at least 6 or 7% yield. So that makes me really in a better situation than them. If they do that, they won't be able to sustain themselves. So I don't know how they will be able to compete with us in this sense. And let me tell you the result. I mean, I'm not saying that because I'm pitching it. That's what happened. For example, we have some parameters. We have some what we call criteria or parameters. That we can judge our performance in the hotel industry. For example, we have what is called market penetration index, which is the difference between the theoretical occupation and the real occupation that we're getting. Okay, to understand how much we are outperforming, the theoretical occupations and the market. And we're doing really well. I make an example. If we had, for example, in this city, 200 rooms, okay, and we have a demand for 100 people. Okay, we have 100 rooms, and we have a demand for 100 people. And theoretically, we should get 50 room each. So 50% would be the occupancy, the theoretical occupancy rate. But what happened? The truth is different. Is that the hotel that is better managed, the hotel that can have a distribution management advantage or marketing advantage or any type of advantage like the price advantage that we have, can perform better than the other. So probably I'm gonna get 80, you're gonna get 20 or things like that. And the difference between the theoretical, the difference that there is, the proportion that there is between the theoretical occupation and the real occupation is the market index penetration. We have in a market that has 52% theoretical occupation, which is Santo Domingo, we have a 97%, 98%, sometimes, in general, 98% occupancy rate. We're always full. It's crazy. So we have 98 divided by 52. We have 180, 190% market penetration index. We are outperforming the theoretical market much more. So it means we're doing something better. We're on the right track.
Antonio, you said something really interesting. It is that you have a lower cost structure of your assets. And I have a question about that. What happened for your assets compared to the market in a crisis situation?
Well, exactly. In the event of a crisis, a downturn in the economy and maybe an increase in supply, what happened is that obviously we'll be connected to the price sensibility. And what happened will be that we will be able, eventually, if we have to lower our rates, and we to still be able to fulfill a number of occupancy rate. And if we did a calculation that if the economy will be collapsing, for example, and I will be able to cut my our fee of 35-40%, and my clients, will still be able to, in that case, I can reduce, of course, some of my workforce, reduce my fee as well because of that, and we'll be able still to produce, a 6.5% yield, even in that case. So, I think that it's really good. We will be outperforming any other type of asset. And in that situation, high cost leverage hotels, the main street hotels, will not be able to sustain the business. They will probably close down. So we'll get even more business because, if they will be closing down, then eventually
you will take the whole market.
Of course.
And what about the crisis? Let's talk about that. How do you see the Dominican Republic in the next years? I don't know, worldwide.
Well, worldwide, I think that we have been experienced for 10 years a big growth. Big growth which was facilitated obviously from very low interest rate, money printing. And, now obviously, I don't know the exact timing. If I would know, I would be a billionaire. But I know that we are in part of the debt cycle. That is probably where eventually, a crisis in the next 2 years could be imminent. Okay, asset prices are very expensive. So I do expect eventually there's going to be a correction. In the States, whatever will happen in the States will be directly correlated also in the Dominican market. Dominican market is correlated in a big way to the American market. So if stocks, for example, if the market will collapse dramatically, if there's a downfall in the economy, we're gonna feel it in this country, okay? But our asset will be still performing, that stable cash flow, okay? Unless you're not in a rush to sell your asset right away, okay? You will not experience big volatility because you still have an apartment in the city center, and you'll be doing better than other assets. Think yourself, if you're gonna be invested in stock, all your money in stock, you're gonna feel the pain of a 40-50% drawdown compared to an apartment in the city center that you're gonna be able to sell, eventually, and this which is giving you a check every month. Okay, no comparison. I always say to my clients, if you're looking for a quick get rich quick scheme, or to buy something and to sell it for 100 times more, I'm not the kind of guy you have to call, because I don't have that kind of asset. You could invest in a value stock if you have the gut to be able to take that kind of volatility, 30-40%, and eventually grow your money in the next 10-20 years if you pick the right asset better. But my clients are clients which are wealthy, which they want to preserve their wealth, or they want to locate a part of their wealth into something stable. Okay, they say, hey, of course we could invest in stock or in other assets that have a greater potential eventually. Okay, but those assets we need to take a big hit one day, and we need to be able to cope with it. Some people are not able to cope with that, and that's where they make mistakes and they sell in the wrong moment. So the type of wealth they give to us, or they invest with us, is people, or is a portion of their wealth where they say, I want to sleep at night. I'm gonna have an apartment there. Every month I'm gonna get my check. If economy goes great, my check's gonna grow. If economy goes bad, it's still a good check. Okay, and eventually this asset will be able to be resold, in a good market for much more than I paid for. And that's what we look, and that's what my clients are. So I think compared to the others, we're gonna be better. But when there is a crisis, and everybody somehow will get hit. And in relation to your question, to be honest, I think the best person which I could consult to tell me how eventually is going to do through the crisis Dominican Republic is you. I mean, you have an amazing experience in trading for one of the biggest bank here in the country, and you've been working with the biggest, some of the biggest investment, the pension funds, as a trader and as a portfolio manager. So please, what would be your opinion about the performance during, and the correlation with the States, the performance during an eventual downturn in the economy here in the Dominican Republic?
It is a really good question, Antonio. To talk about the Dominican Republic, the first thing we have to say is where we are. Dominican Republic is at the center of the Caribbean, and it's a small country, small economy of a developing country. We are really specialized in tourism. We have the best beaches in the world, known like Punta Cana, but that's not the only thing the country has to offer. You said about the dependency that we have, the correlation that we have with the States. It is real. We have a really big correlation with the United States, but I think we're taking the steps to diversify our need in the United States. Right now, there is the recent months, the Dominican government has signed a U.S. treaty, a commerce treaty with China, which is going to make a real good channel for new investors to come, and not only invest in what we already know or what we have been known for, which is the tourism. That they can invest like in infrastructure, agriculture, and try to develop the other sectors that really need that we can really push up to make a stronger economy. And something really important about that is not that only those treaties have been signed, but also the investors are starting to believe in that we are making the right choices as a country. One really big proof of that is the history that we have in the stock market right now. In the couple of years, we have made real good issues, placements of debt, that goes from 5 to 10 to 15 or 20 years. And we are doing it with just one digit rate, about 5 to 6 to 7%. And one important thing to talk about is the last year we made a really good placement that it was in Dominican pesos, and it was placed in the international market, and that one went just like 8.9%. So we are really making a real good impression in all of the investors. They are starting to believe in the Dominican economy. We are growing at a really steady growth rate, about 5 to 6, 7%. And we think that that is going to make sure that the Dominican Republic slowly, gradually start to depend less on the United States of America and on the tourism and the basic sectors that are in the other countries in the Caribbean. And we are starting to develop the sectors that have been the key sectors for other countries, developed countries, to growth. Antonio, and what do you think is the next hot business that you see coming from Real Capital Caribe?
You know, I think geographically, we're looking around, and we still think there is a lot of potential in the Dominican Republic, and asset prices in Europe and North America are too high. We are thinking about the same asset, but we are thinking to restructure them into a different type of format. We believe that the digital revolution, as it did disrupt the hotel industry, is going to, and is almost, disrupting the finance industry. That's why the fintech is coming up now and things like that. So we think that we can create vehicles that can eventually be sold in a tokenized way. Okay, so you could buy. Think about it. Many clients tell me.
If you say tokens, do you mean blockchain technology?
Yes, of course. I mean blockchain technology. Security token offering, for example. Think about how many clients constantly ask me, Antonio, please, I'd like to buy another 2 or 3 units from you. Or maybe some people want to buy an extra unit, or 2 units, but they don't have the money. So they can only buy one, or they can only buy, sometimes they don't reach the minimum budget to buy one. And those clients, will happily give me 5 or 10,000 or 20,000, so a portion of their money, okay, to join, for example, to be part of our hotel, not necessarily by owning an individual condo, but owning a part of their business, okay, or over land, or over debt. If as you know, we also invest in debt which are backed by assets, and that could provide them a constant cash flow. And if you do that in a regulated market, within all the security and the trustee and everything, then it can be a very interesting vehicle of investment. And we're working on that, and the market is still not mature, but it's going that direction. So I think in the next few years, that's what's going to happen.